Welcome back, and my name is Curtis Storr, trainer with Family Investor. Probably know that already, but if I post this outside of our trainings, I want people to know who I am. This is one of the basic trainings, and this is on taxes. We're going to talk about taxes. And the reason we're talking about taxes, it's another way you lose money. It's a very important subject to know because it's the rules. You have to know the rules of the game so you can play the win. If you're playing football, baseball, whatever game you're in, you have to know the rules, or how are you ever going to win at anything? And I apologize, even for this basic training, there's going to be a lot of information thrown at you during this training here. So once again, I'm going to ask you, watch the training all the way through. Just watch it and then go back and watch it again. And then you could download the worksheet and the notes and stuff, and you can start taking your notes and coming up with questions. If you really have a critical question and you're like me, you're afraid you might forget what that is, or whatever the thought is that comes across your mind, pause the video. You can watch these videos over. You could pause them. So pause the video and write it down if you have to. But I do still recommend that you watch it all the way through. Okay? So let's get into it. Taxes. Okay, you guys. Some of you need to wake up. I know. Sales, local, state, and federal. You think of those taxes as different companies. Different companies are charging you to use your money. Or when you earn money, state and federal are usually on the earning side, and sales and local is when you spend it. Like if you buy something, you have to pay sales tax, and you have a home, they charge you property taxes. Well, I think I'm getting ahead of myself a little bit here. So let's go over the federal taxes. It could be up to 39.6%, almost 40% taxed, depending on your brackets, and I'll go over that in a little bit. And Social Security also, they charge you 4.2%. That's a percentage. State, it varies from state to state, and I'm going to show you some interesting stuff here. And sales tax, like I said, whenever you buy something. Local taxes, most of the time, they're property taxes. And you'll see here, combined rates. See, if you really put the rates together for your sales and local and state taxes, Washington State has high sales tax, but no income tax. And Oregon has no sales tax, but has high income taxes. No matter what state you live in, they structure it the way they want to, but they're going to end up getting your money. And the 5 states with the highest average combined state local sales tax rates are Tennessee, 9.45%. Arkansas is 9.26%. Alabama is 8.91%. Louisiana is 8.91%. And Washington, 8.89%. The states with the lowest average combined rates are like Alaska, which is 1.76. They do that because they need to get people to move there, right? Hawaii, 4.35%. Wisconsin, 5.43%. Wyoming, 5.47%. And Maine, 5.5%. A lot of the wealthy live in Wyoming. Now you know why. And Hawaii, though, is a different thing. Their combined rates might be lower, but have you ever bought a gallon of milk in Hawaii? When you go to Hawaii, look at the prices when you go shopping. They're high. So, they're making up for it over there. because if you pay $5 and pay 10% tax, it's the same as paying $10 and paying 5% tax. Either way, it's the same amount in the end. I hope you understood that. I'll provide you with a link also that you know, as reference, where you could go look at some of this stuff. You know, like one of the tidbits that I like is Delaware and how it gets its revenue, because Delaware's, you know, at one of the very less expensive state taxes. Okay, enough on that. This is a basic training. I don't want to overdo it here. Tax brackets will determine how you're taxed, and I got this website I'm going to go and you pay incremental amounts depending on how you're filing. A lot of you know this, but this is a basic training, so I have to cover it. Here's a website that I provide the link to. It's irs.com. It's not the government site, but in this link it shows you federal tax personal exemptions and standard deductions for 2016. This is handy. This is where I get a lot of the information to build the latest calculators, because it's the latest information. It's 2017 currently, so I don't have that information yet. So it shows you that here you'll have tax brackets. Right here in the middle, you'll see tax brackets here, and depending on how much you make is depending on what your charge. Like a single person up to $9,275, your tax rate is 10%. Then for everybody who makes that much money, even if you make more than $9,275, you pay 10% on that amount. So if you make $37,650, as shown in the next bracket, you pay 10% on the $9,275, and then you pay 15% on here. So you'll see that each one, and it explains it here, but I'm trying to make it clear, you pay that amount up to the max. Then when you go $1 over, boom. That's why a lot of CPAs, they look at your taxes, and if you have certain deductions, they want to try to get you, your goal is to get down to a lower tax bracket, right? So that's part of the game, getting down to a lower tax bracket. And then if you want to look at it, you can go down here for personal exemptions, how much they'll exempt you. But most of the stuff you'll get through a CPA. But this training is just so you can start understanding taxes. Okay, moving right along. Okay, the tax deduction reduces your income. We're going to talk about, because people will say, okay, you could get a tax deduction for that. Well, that's different than getting a tax credit. Like a lot of the solar people say, hey, you could get a tax credit for that. And there's a difference, and that's what I'm going to explain right now. The tax deduction is a reduction in your income. So if you pay $10,000 and you're in a 28% tax bracket, you get $2,800 reduction in taxes, because you don't get the full $10,000. You know, even though you paid interest of $10,000, you don't get to deduct the full amount. It depends on what tax bracket you're in. Now the tax credits are different. It reduces how much tax you owe. So after doing your taxes, let's say you owe $2,800, or the $2,800 credit goes against what you owe. So in other words, if you owe $10,000 to the state or to the federal, depending on what the tax credit applies to, because there's obviously the two different entities that are taxing you. Tax credits can go, you can get $7,500 for federal and $2,500 for state. So that means that $10,000 tax bill is reduced to $2,500 on the federal level. I'm probably confusing you because I'm jumping back and forth. So it's a deduction off that, not your income. It's what you owe, you can deduct. So and just a little tidbit, let's say you have a $10,000 tax credit for solar installation you did on your home, and you don't use the whole thing in the first year, in most cases it'll roll over to the next year. Okay? And Arizona has a qualifying charitable organization tax credit. It's considered also known as a school tax credit. I don't know what states have it. If you have private schools in your area, they're usually .orgs. So they're a 501c3. They're a nonprofit organization. Okay? Those nonprofit organizations, if you were to donate the taxes you owe, so let's say you owe $2,500 to the state, you can write a check instead of to the state to a qualified charitable organization and not have to pay the state that $2,500. This is a great thing to know because in Arizona, a lot of families that have children going to private schools, they donate that money to the school that their children are going to. You can't donate it directly to your child. You could give it to a friend's child, okay? But and it'll reduce their cost of going to that school. It's like you're paying their tuition if you donate it directly to a child. If you donate it to the school, then it just goes over to cover their costs. I hope that makes sense. That's a really great thing to know. That's why I threw it in early in this training, even though this is basic training. I want you to know that because I want you to know that right away, because you can look that up for your state. And I provide you with a couple of links that you can take a look at that. Okay? Got to keep going, otherwise this is going to be a long training. Okay, for those of you or us that have a lot of deductions, okay, there's a thing called the alternative minimum tax, AMT. And this is to prevent anyone or any corporation from not paying any taxes at all because they might have more deductions than they do income. Believe it or not, you can end up at the end of the year with zero income. And that's why, little tidbit, and that's part of the game. And that's why some of us set up C corporations, because in a C corporation, they say, oh, watch out, it's double taxed. But you can also pay yourself a salary and only be taxed once because you have all those deductions. But we'll go into that in business. That's a little bit advanced, but that was just a little tidbit. So, you make this calculation. So whatever is higher of the two, you would pay. Let's say you're under that tax rate, it's $13,663, but calculated under your regular taxes is $21,720. You pay the higher of the two. So it's basically, you can't get away from not paying any taxes. Okay? It's the tidbits that you should be writing down. just as a little hint. Here's the thing that I don't know if you know, if I'm a advisor on Investopedia. This came up. gentleman inherited a lot of money and was a little bit confused about what taxes he had to pay. Well, there's estate taxes and inheritance tax, or they call them both death taxes. An inheritance tax is mostly on a state level, and it varies from state to state. Once again, each state writes its own laws. Estate taxes are federal level, and so it only their ruling currently is it only applies to states over 5.45 million. You know, even though they sound like the same tax, one is state and one is federal. So again, you're being taxed by both for the same money that the person you inherited from had already paid both those entities taxes on that money. So actually our current president, President Trump, 2017, is trying to eliminate or minimize these taxes because, like everyone else, everybody feels my father, my mother, whoever you inherited the money from already paid federal and state taxes on all that money. They're just handing it off to their heirs. And you're probably sitting there going, okay, you know, I'll never have 5.45 million. Well, you're in a family investor training. We will show you and teach you methods that'll allow you to build a portfolio larger than 5.45 million. That's why you need to know this. Okay? If you're in this training, you need to know this stuff. And this is just the basic stuff you need to know. Okay, taxes and my purchasing power. Each dollar not paid is a dollar earned. Tax law is really an incentive program. Marriage and children, buying a house, starting a small business. No matter what you do, you can get a deduction for doing certain things. Like in a small business, you could go out for drinks with somebody. You could have meetings. You could have a corporate meeting in Hawaii. All these things are in the tax law, and the tax law is written as incentives for you to do things. If you get married, you get a little, well, it depends on your situation. It can reduce your overall taxes you have to pay. Usually not by enough. So we teach you how to reduce it quite a bit. People, my friends, my family, people who work all year round, and they sock away, they pay more taxes than they really need to get that big refund at the end of the year. That's ridiculous. Please don't do that. If you get a refund, then you're missing out on making interest, or you're throwing away money, basically. Or you could have put that money into one of the strategies and made a six-figure passive income. Silly. And the reason people do it, and I totally understand, and that's why our trainings are built the way they are, is because if it automatically comes out of your paycheck, then you won't spend it on frivolous things. I get it. And then at the end of the year, you got this big check to pay for a vacation. That's what most people do. I'm paying for my vacation. But if you think about it, you may be able to build a retirement that would pay you $5,000 a month, tax-free, versus building a retirement that would pay you $5,000 a month, tax, which comes down, then you only get $3,500. It's like, which would you rather have? So taxes are really important to know. Another little tidbit there. Okay. That wasn't as painful as we thought, right? You got through it. You probably didn't fall asleep. I kept it short on purpose. we do go a little deeper in our deep dive training. So I want to leave you with, if you have questions, once again, please write them down, get through all your basic trainings, and start your deep dive. And if your questions don't get answered, or if it's critical, send it to us at support@familyinvestor.net. But I will try my best to cover all your questions during these trainings. So hang in there, start a sheet. You should have already done that several trainings ago, but make sure you write down on your question sheet all the questions that are gone unanswered. Or you could, send them to me, mail them to me. And another little tidbit about the trainings that follow based on taxes. I said, a penny saved is a penny earned. No, it's not true. The truth is a penny saved is better than a penny earned, and I'll teach you why. Well, the answer's right there, because taxes take part of that. It's like that example I just gave you. If you create passive income of $5,000 a month and you're taxed, that's actually $3,500 a month. I'm just throwing numbers out there to get the concept through your head, so you start understanding the new rules you need to play by, or the rules you need to play by. These are not, I'm not making up these things. These are what the wealthy use to continue to get ahead. So I thank you again for going through this training and look forward to seeing you in the next one. Congratulations.